So straddle. So straddle is simply a strategy wherein you're putting up a put trade as well as a call trade simultaneously at the same strike price. So most of the time you'll want to be buying a call option, buying a put option simultaneously at the same strike price, which is called a long straddle. So here your maximum risk is always capped out to the extent of the total premium you have paid for purchasing these two options, and your maximum gains can be unlimited, as is the case in buying any of the options. When would you want to employ? So this is critical. When would you really want to do a straddle kind of a strategy? So as you can very clearly see here, one side is going to gain and one side is going to lose if there is any price movement. So you deploy this strategy. You would want to deploy the strategy only when there is a major price movement which you would expect in the market. Now, what are the typical triggers for a major price movement? So there could be an earning result which is round the corner, and you expect that the earning result is going to trigger a major price move because probably there's going to be new additional information to which the market may react. There could be elections which can really move the index. So you might want to do, a lot of people have traditionally done long straddles during the election times, but that is something one needs to be a bit careful about because option premiums get very expensive. So as a buyer, it becomes expensive. But we'll come to that later. So, what could be the third event? The third event could be that there could be just some regular news which is about to come out, some regular new information which is about to be released about a stock, and you anticipate that the market will react quite significantly to that new additional information. So, it could be an earning result which always provides some of the other new information or some of the other new forward guidance regarding the stock, or it could be some midterm news which could be a market moving news, or in the case of an index, it could just be an election. So these are typically the scenarios where one would want to deploy a straddle kind of a strategy wherein you're buying a call option and a put option simultaneously at the same strike price. So what will happen is if there is a major price move, as you can see here, if the price either falls significantly or goes up significantly, you would have already covered the entire premium which you have paid for the option and you'll start making money, as you can see out there. So, you know, uh, so the current spot price is, here we are doing an FT straddle. Let's say the current spot price is 10,760. And on the downside, we will not make any money till about this point. And on the upside, we will not make any money till about, let's say, till about a little above 10,867. So, we have paid a total premium of we have paid a total premium of 150 per unit. So the current spot price is 10,760. So on the upper side, we will not make any money till the price goes to 10,910 and above. So that becomes our break even on the upper side. On the lower side, our break even becomes 10,760 less 150, which is 10,610. So we are expecting a major swing in the market on either of the sides. So we are direction neutral. All we want is that the price should be moving very wildly in a very short period of time so that we get to cover the entire premium that we have paid to deploy the strategy and we start making gains. So we have covered this scenario wherein you're the buyer of a straddle strategy. When you are a seller of the straddle, when you are a seller wherein you are selling a call option and you're selling a put option simultaneously at the same strike price, what could be the potential scenario when you want to do that? So mostly you would not want to do that. You might just only want to consider that when the implied volatility, and implied volatility is a concept which we'll cover a few videos down. So it's only in that scenario when the implied volatility is highly inflated and you expect that whichever way the price moves, the implied volatility is going to reduce and hence the premium will reduce and you will gain as a seller. Only then one might consider a short straddle. But that is for much later. For now, just bear this in mind that straddle is a strategy which you would want to deploy if you're expecting a major change in the price in either direction. Okay, so one more point I would like you to notice is this. If you see that whenever the strategy actually works, whenever you're sure and you're right, and there is a major movement in the price, you'll actually see the return on capital is very significant. So it can be a very profitable strategy if you get it right. But on the other hand, if the price really doesn't swing enough, it can pretty much wipe out your entire capital. So even the negative ROC is quite significant, but if you were to get it right, if you're reasonably sure, it can be a very profitable strategy. So I hope you enjoyed this video. In the next video, we'll talk about yet another strategy which is called Strangle. Strangle can be a very relevant strategy to deploy in the market quite a few times because most of the time the prices are not trending. And Strangle basically is a trade which works on a range bound price scenario.